Okay, let's unpack this. We're diving into some really foundational stuff today. Benjamin Graham's The Intelligent Investor.
hmm The absolute bedrock for so many people.
Yeah, exactly. And look, we're not talking about hot stock tips here or, predicting the next market move.
No, definitely not.
This is about principles, ideas so solid they've weathered every storm the market's thrown at us since the Depression. Real counsel, as Graham put it.
That's his legacy, isn't it? He basically invented security analysis. So our mission today really is to give you the core toolkit from Graham. It's about mastering the emotional side and the analytical tools he laid out.
And why? What's the goal?
Simple, really, to help you minimize those big permanent losses and hopefully maximize sustainable, steady gains over the long run.
Okay, and right off the bat, Graham throws down a really important distinction, doesn't he? Investing versus speculating.
Huge difference. It's not just words. It's fundamental.
It sounds like the difference between having a real strategy and just, well, hoping for the best.
Exactly. For Graham, an investment has to meet three criteria all at once. First, you got to do your homework. Thorough analysis,
Meaning?
meaning you study the facts, you compare them against clear standards of safety and value. No shortcuts.
Okay, thorough analysis. What's second?
Safety of principle.
Yeah.
You need solid protection against losing your initial investment under, normal or reasonably likely conditions.
And third?
An adequate return, not necessarily spectacular, but decent, satisfactory.
So if an idea doesn't tick all three of those boxes,
And it's speculation, plain and simple. And here's a key mindset shift he pushes. A stock isn't just a ticker symbol bouncing around.
right, it's part ownership in a real business.
Precisely. And that business has an underlying value that's separate from whatever the market's shouting about today.
That really changes how you look at volatility, doesn't it?
It's the only way to stay sane, honestly.
Ah.
Which brings us to the emotional framework. Taming Mr. Market.
Ah, yes, Mr. Market. Before we get to him, you mentioned the market being like a pendulum.
Yeah, Graham saw it swinging constantly between two extremes. You've got unsustainable optimism on one side.
Where everything gets way too expensive.
Exactly. And then it swings over to unjustified pessimism.
Where perfectly good businesses get thrown out with the bathwater cheaply.
And the intelligent investor. They're a realist. They stand apart from the crowd, buying from the pessimists way down here and selling to the optimists way up there.
Easier said than done, I imagine.
Oh, absolutely. Which is why Graham gave us his brilliant metaphor, Mr. Market.
Okay, lay it on us. Who is Mr. Market?
Imagine you have a partner in private business. And this partner, Mr. Market, well, he's extremely manic depressive.
Ah. Okay, I can picture that.
Every single day, he comes to you. And he offers to either buy out your share of the business or sell you his share.
Every day.
Every day. And the prices he quotes, they're all over the place. Completely driven by his mood swings, his fears, his excitement. Totally irrational sometimes.
So one day he thinks the business is the greatest thing ever. The next day it's doomed.
You got it. So Graham's advice is, most of the time, just ignore him.
Ignore him, even if he's offering a ridiculously high price. Or a terrifyingly low one.
Mostly, yes. You focus on the actual performance of the business. Are the dividends coming in? How are the operations doing? That's your reality.
But realistically, how do you actually ignore a, say, 30% drop when everyone's panicking?
It's incredibly difficult. It takes real discipline. That's why Graham says you should view those price swings only as potential opportunity.
Opportunities.
Yeah, if the price falls dramatically, way below your assessment of value, maybe that's an opportunity to buy wisely.
Okay.
And if it shoots up way beyond reason, maybe that's an opportunity to sell wisely. But otherwise, you let Mr. Market have his tantrums and focus on the long game.
It seems like the people who get hurt are the ones trying to predict Mr. Market's moods.
That's exactly it. Think about the day traders in the 90s, or even some of the stuff we see today. They're focused on being right temporarily, getting that quick win.
Instead of being sustainably right over years and decades?
Precisely. And that chase for quick wins often slides into what Graham called unintelligent speculation. He flags three big ways this happens.
Okay, what are they?
First, probably the most common, is speculating when you actually think you're investing. You haven't done the work, you haven't checked the safety, but you convince yourself it's a solid investment.
Deceiving yourself, basically.
Kinda, yeah. Second is speculating seriously, like it's your main plan, when you just don't have the knowledge or the skill for it. It's not a game.
And the third?
risking more money than you can genuinely afford to lose. That's just gambling with your future. You have to know your limits before you start.
Crucial points. Okay, so that's the mindset, the emotional discipline. Let's shift to the practical side. Portfolio strategy for the defensive investor.
Right. Graham was pretty adamant that most people fall into this category, or they should.
The defensive investor. Who is that exactly?
It's someone who wants, primarily, safety and freedom from effort. They want satisfactory results, but they don't want to spend a lot of time or emotional energy on it.
Makes sense for a lot of busy people.
Absolutely. And Graham felt trying to find some middle ground between this passive approach and a more active, aggressive one usually leads to disappointment. Go defensive or go aggressive, but don't get stuck in between.
So for this defensive investor, what's the first big decision?
Asset allocation. The split between stocks and bonds. This is the most fundamental choice.
And what did Graham recommend?
He suggested a default starting point of 50-50. 50% in high-grade bonds, 50% in common stocks.
Just 50-50, always.
No, that's the baseline. He said you should adjust it based on market levels, maybe go down to 25% in stocks if the market seems really high and risky, or up to 75% if stocks seem incredibly cheap.
Interesting. So the allocation is just based on valuation, not based on how you feel or news headlines.
Exactly. Formulaic. And what's really striking, especially compared to advice today, is that Graham never mentions your age as a factor in how much risk you should take in stocks.
Really? That's like the first thing most advisors ask.
I know. But Graham's focus was purely on the price the market was offering relative to value, period.
That's quite a detached perspective. So how do you execute this mechanically? Avoid getting swayed by emotion.
Dollar cost averaging.
Yeah.
DCA. He was a huge proponent of this.
Yeah. Okay. Explain DCA quickly.
Super simple concept. You invest the exact same amount of money, say $200 every single month or every payday, into your chosen investments, regardless of the price.
So sometimes you buy more shares, sometimes fewer.
Precisely. When prices are low, your fixed $200 buys more shares. When prices are high, it buys fewer shares. It forces you to buy more when things are cheap, the exact opposite of what our emotions usually tell us to do.
Right. Panic selling low and euphoric buying high. DCA automates the sensible approach.
It guarantees you end up with a satisfactory average price over time. And today, this is even easier.
How so?
Index funds. The defensive investor can pretty much put their strategy on autopilot with just, say, 3 broad index funds.
Which one?
Maybe a total U.S. stock market fund, a total international stock fund, and a U.S. bond fund. You DCA into those 3.
And you've got global diversification, you're benefiting from growth wherever it happens, and you're doing it systematically.
You got it. You can basically answer most market panic questions with, I don't know, and I don't care, I'm just buying my regular amount. It
Right.
takes the emotion out.
Okay, that makes a lot of sense for the defensive path. But what if that investor says, okay, I get the index funds, but I still want to own a few individual stocks?
Graham allows for that, but the bar is incredibly high. This isn't about adding a bit of speculative fun. It's serious business, even for the defensive investor.
So strict rules apply.
Extremely strict. First, you only look at large, prominent, conservatively financed companies, and they have to pass several tests. Financial condition first.
Like what?
Current assets should be at least twice current liabilities. That's the famous 2-to-1 current ratio.
Why is that specific ratio so important? What does it tell you?
It's a huge safety cushion. It means the company could pay off all its short-term debts immediately using its liquid assets and still have half those assets left over. It shows resilience against shocks.
Got it. Liquid safety net. What else on finances?
Long-term debt shouldn't exceed working capital, which is current assets minus current liabilities. Again, keeping debt levels manageable.
Okay, strong finances. Then what?
Earning stability. The company needs to have shown some profit for its common stock in each of the last 10 years. No big losses recently.
10 years of positive earnings and dividends.
Yep, a long record of continuous dividend payments. Graham suggested at least 20 years uninterrupted.
Wow. Okay, 20 years of dividends. And finally, the price has to be reasonable, right?
Absolutely critical. Moderate price to earnings ratio. The current price shouldn't be more than 15 times the average earnings over the past 3 years.
Past 3 years average. That's key, isn't it? Because nowadays, so much valuation is based on forecasts of next year's earnings.
Exactly. Which are often just, educated guesses, sometimes wildly optimistic ones.
Right.
Graham insisted on looking at proven historical results. That 15 PE is based on what the company has actually earned.
Stick to the facts.
Right. And you can see how these rules automatically steer the defensive investor away from most growth stocks.
Why is that?
Because exciting growth stocks, think of, I don't know, early IBM, Microsoft, Cisco, they usually sell at very high prices compared to their current earnings. The market price is in huge future growth.
Which might or might not happen.
Correct. Making them inherently riskier and too volatile for the defensive investor. They're vulnerable to sharp drops if that expected growth disappoints even slightly.
Like you mentioned, IBM lost half its value in 61, 62. Cisco dropped over 75% after the dot-com bubble.
Those aren't small dumps. That's the danger when enthusiasm disconnects from underlying value. Graham saw this happen time and time again.
He gives some historical examples of hype, bro.
Oh yeah. The Save-Old Tire Company back in 1919, its stock shot up 250% on the first day. Pure hype. Turned out to be a fraud. Worthless within months.
Ouch. A lesson from history.
And it repeats. Think about the late 90s. The VA Linux IPO in 1999.
I remember that craziness.
Stock soared almost 700% in one day. The company was valued at billions, but it was actually losing millions on relatively small sales. It completely violated Graham's rule of buying a good business cheaply.
Hype over substance. Okay, let's pivot slightly. What about things like inflation? How did Graham view protecting against that?
Well, inflation's always been around. Graham initially wasn't a big fan of using gold or commodities as a direct hedge for the average investor. But today, we have a much better tool.
Which is?
TIPS, Treasury Inflation Protected Securities.
Ah, okay. How do they work?
Basically, the bond's principal value adjusts directly with the official inflation rate, so your investment keeps pace with rising prices. It's the cleanest way to protect purchasing power.
Probably best held in a tax-deferred account, I guess.
Yeah, the tax treatment can be a bit fiddly otherwise, but in an IRA or 401k, they're ideal for that safety-first portion of the portfolio. They're the modern standard for inflation protection.
Got it. Another modern issue is companies holding huge amounts of cash. You mentioned Microsoft earlier.
Right. Historically, the market tended to favor companies that paid out generous dividends. Now you see giants like Microsoft, Apple, Google sitting on mountains of cash, way more than they can realistically reinvest back into their own businesses at high rates of return. Microsoft had like $38 billion back in 2001.
So from a Graham perspective, is that a good thing or a bad thing for shareholders?
It's questionable. If a company has tons of excess cash, isn't reinvesting it effectively, and isn't paying it out as dividends, Graham would argue management might be misusing that capital, especially if the core business is struggling or the stock's lagging.
So paying a dividend can actually be a sign of good management discipline.
There's research suggesting that, yeah, high current dividends often correlate with better future earnings growth. It forces management to be efficient and return excess cash to the owners, the shareholders.
Interesting connection. Okay, so far we've mostly focused on the defensive investor. What about the other path Graham mentioned? The enterprising or aggressive investor?
Right. This path is only for those who have the time, the skill, the interest, and, frankly, the temperament to treat investing like a business operation. It requires serious effort.
So not for dabblers.
Definitely not. If you meet those criteria, Graham says you can aim for better than average returns by seeking out bargain issues.
What defines a bargain issue in Graham's world?
It's not just a stock that looks cheap. It's a security where your detailed analysis convinces you its intrinsic value is significantly higher, say, at least 50% higher than its current market price.
Can you give an example?
His classic case was Northern Pipeline. The stock was trading around $65 a share, but Graham's analysis showed the company held about $80 per share just in high-quality bonds on its balance sheet. Clear disconnect between price and underlying asset value.
So the enterprising investor is basically a value detective.
Kind of, yeah. They often look for unpopular large companies whose stocks are trading at low multiples of earnings or assets, maybe due to temporary problems or investor neglect.
Sounds like hard work.
It is, and even for these skilled investors, Graham strongly warns against concentrating too much money in just a few ideas.
Why is that? Seems counterintuitive if you find a great bargain.
Because concentration, while it can make great fortunes, is also responsible for most great financial failures. One bad bet can wipe you out.
So diversification is still key, even for the pros.
Absolutely. Owning maybe 20 or more different stocks or funds is crucial. It's a safety measure, always.
Okay, we've covered a lot of ground. The emotional discipline, the defensive strategy, the enterprising approach.
Yeah, the core principles are remarkably consistent.
So, what does this all mean? If you had to boil down the single most important lesson from Graham for our listeners, what would it be?
Hmm. For me, it's that the biggest risk in investing isn't actually in the stocks or bonds themselves.
Where is it then?
It's in you. It resides in what kind of investor you are, your temperament, your reactions.
So, if you can't handle seeing your portfolio drop temporarily without panicking,
Then you're probably not ready to be a stock investor no matter how good the companies are. You need that emotional fortitude.
mm,
Controlling yourself is more important than picking the perfect stock.
that really puts the focus back on the individual. And the core concept underpinning all the analysis is that margin of safety.
The margin of safety, that's the whole game. It's simply ensuring you buy assets for significantly less than you think they're worth.
Creating a buffer for errors, bad luck, unexpected events.
Exactly. So even if your analysis isn't perfect or the economy turns down, you've got protection against major loss. And diversification is the essential partner to that margin of safety. Don't put all your safe bets in one basket.
It's about building resilience into your whole approach.
It is. Think of investing as a long journey. And maybe we can end with a thought from Dante, who Graham liked to quote.
Before it.
Dante wrote, "You were made not to live like beasts, but to seek virtue and understanding."
Hmm. How does that apply here?
Well, don't approach your financial future like a beast, just chasing immediate gains or reacting purely on instinct. Seek virtue in discipline. Seek understanding in analysis. That's how you navigate the journey safely and confidently.